Okay, we're good. We're live. I'm sure you guys can hear me just fine. Okay, so Dale, thank you for the topic suggestion. We are going to talk about our gap entries, and there are two. Okay, we'll talk about we have a swing entry for the gap, and then we also have a day trading one. Let's do the swing one because that's a quicker, easier conversation. Okay, so that the swing, so this you'll hear it called gap fill. Charlie and Patrick do those in the Momo room, and we play it the same way with options. So oftentimes what you're looking for is you're looking for some sort of gap. Oftentimes that'll happen after earnings, right? Because that's when you get fundamental changes. So let's think about something that's gapped pretty good. Grubhub comes to mind. Okay, so we're looking at the daily chart here, which is the one on the left. Let's make this a little bit bigger so everybody can see it. Okay, so an obvious gap here where they were before earnings. Those earnings came out and were horrible, and we have this gap, obviously from here to here. What you're looking for in this type of situation, you're looking for the same sort of setup, that you have, the ATR above, you have the which is here now, has moved. You have the channel moving down, you have this moving down. What you're looking for is the gap is defined by low of this bar to the high of this bar. What you're looking for in the next 2 days, you're looking for a rally back towards this gap here. Can you take it at the top of the gap, or right here? Yeah, or you can get in a little bit early, depending on how much the stock is trading for. So kind of your conventional, anything over $100, maybe 25 cents below that. Anything under $100, 10 cents below that. But this is going to be your entry point, and it'll be treated as a regular, kind of like the same way that we did with Tesla with the swing breakout this morning. That wasn't on a gap, but we would play this in this room. We would play it with a vertical spread. Scott might play it with a broken wing fly. He might see a calendar that he wants to do. We'll just do a simple, in this case, put spread. And you're looking for, essentially, if it can't hold this is, you can consider this everybody who's short from here, bought it back up, taking profits, and then it goes back down. These don't happen all that often, but when they do, they are pretty darn predictable. So we haven't done any in a while, but that is what we call, that is the gap bar entry. Okay, any questions on that one? It's pretty straightforward. Big thing to remember is you want your momentum going the same way. Hull down, channel down, ATR above, that sort of thing, and then you're looking for a regression back to the top of that gap in the case of a sell, and then you're looking to take a put spread. And they're meant to, they're not meant to be day trades. They're meant to be held for a couple few. The quicker the better, but I can't force them to do it. Okay, anything else? Well, not on the swing type of trade. I don't. No, I don't try and do this gap. This is a gap bar entry, not the gap fill. Now, once you can make the case that if your gap bar entry didn't work and you start going in here, well, then the logical thing is that, well, the markets do like to fill these gaps. But remember, there was something fundamentally that happened from here to here. So that's why we're trading this on the daily chart. Now we trade in the gap, so now we're moving over to what I call gap fill, and that is done on the 5-minute chart. 5-minute chart. And what we do is I have, and this little piece is out there. You can put this on here, and what this does is this says, hey, go look at our watch list, and everybody has the watch list that has whatever these 80 some odd names. I didn't count them. Go out there and find out anywhere from yesterday's close to today's open. I'm looking for things that have, and tell me what that percentage move is. So for example, Under Armour, they had earnings Earnings weren't great, and they're being investigated for some accounting practices. So that was down nearly 16%. McDonald's down nearly 2%. I'm looking for moves up or down from yesterday's previous close of 1.5% or more. So McDonald's would be something that we would look at. We can look at Under Armour, but let's look at something that's a little bit more reasonable. So that is out there, a little bit more reasonable. We have this gap. And so what I'm looking for is in the first 10 bars, or excuse me, the first 10 minutes, which is 2 bars on the 5-minute chart. I'm looking for a breach of the high. In the case of something that gapped down, I'm looking for a breach of the high. So we would say here, if this gets above there, I want to know about it. I have something else set for McDonald's. Let me take that off. And you can see it did get a little bit through there, and then it just continued right back down. So what's nice about these is that if they work, they start working pretty quickly, and if they don't work, it's a quick stop for you. So it's a low risk, potentially higher reward thing. If it's not going to make its way through the gap, just bail. So what we do is we treat this as a scalp. Scalps are 4% allocations, and ideally what you want to do, and I have this calculation out here for you on the tracker. What you can do is ideally, and I would like to say the management is going to be kind of twofold. We're going to have where do we have that gap? Here's the gap. Okay, so let's just say in McDonald's, that top of the gap was 190.61. So in the gap buy, that's what this is going to be. If we got above 190.61, or excuse me, 190.61 is the low of the gap. The high of the gap was Friday's close, or Friday's low, which was Friday's low 193.86. 193.86. So here's that nearly 2% move. And so what this is saying is, ideally, your first target is 1/3 of the way through the gap. The next target is halfway through the gap, and then the full thing is that it actually fills the gap. And then, like I said, if we get something that looks like McDonald's did, and pokes itself up above, just a few cents above, and then starts going down, you stop yourself out. So your ideal targets for something like this would be 191.69. 191.69. If we get 191.69 would be 1/3 through the gap. Halfway through the gap would be 92.24. At or above 192. Did I say 24? Yeah, 192.24. And then the full gap, that's easy. That's just the low of this. Now, of course, I'm not just going to sit there and hold it and hold it and hold it. We'll look at our scalp charts, and if we buy this gap, now of course these are 3-minute bars, we buy this gap and we see that we get through the gap and we get through the VWAP, and then it starts to pull back. Well, maybe we want to stop ourselves out a little bit sooner. And in this case, we just use a regular call or regular put, depending on if it's a buy or sell. So one of the gap methodologies is based on day trading and is based on a 5-minute chart. The other one is a swing trade that is based on a daily chart. Okay, what questions do we have here? So let's look at some examples from today to the upside. We had a couple upside gaps. Let's look at, pull these in here. Let's look at one that we, let's look at Baidu. China's always in the news, right? Enter. Come on. Okay, so we had this gap here. We actually set this. It never came back. So there was no gap, potential gap fill in this one. Never came back. What was another one? PDD. Same thing, never came back. It's getting there. And I will say that the strength of this gap wanes as time goes by. So if this actually comes back, I don't know that I would be taking this when we're basing this on the first 10 minutes and now it's 11:40 in the morning. Kind of, you know, this game is over with. So those are usually first hour type of trades. That's what I would characterize them as. Micron gapped up over 2%. Gapped up, we were looking for that pullback, never got it. See if anything did pull back. Halliburton. Halliburton never pulled back. So I'm looking for moves 1.5% up in a case of a gap fill to the, you know, you're taking something that gapped up, seeing if it's going to regress back, and then 1.5% down to see if it pulls down and then goes up from there. All right, any questions on that? Like I said, this was recorded. I'll get that video out to you. I know Daniel was in here actually videotaping me doing this, so that'll be either on the blog, on Facebook, on Twitter, whatever the heck they do with that. But those are the two. They don't happen all the time. And there was a time when this gap fill was really, really, like, maybe almost this time last year. This was like bread and butter. It was almost, you know, too easy. We're not seeing it as much. We will, but not as much. Like something like NVIDIA today. Oops, I don't want that. So here, this would have been our entry. The low of this one. We can see that it poked through here. So it poked through at 205.54, and then it traded down as low as 204.85. So now we would probably, and that is most likely not a third of the way through that gap. So maybe, you know, we're looking at this and we're like, man, it can't make new lows, maybe we would just cut bait a little earlier. Dale says, like Hal, if it goes back to the top of the gap and then goes higher, that is, let's pull Halliburton up here if I can get my chart again. So if Halliburton, are you looking on the daily chart, or you, because there's no real gap on the daily chart. There is a bit of one, but it has not come back and retested it. And remember, we can't do it today because the gap hasn't been defined. Here, if you're saying that if it rejects and goes higher, is that an entry? It might be somebody's entry. I don't use it as part of my methodology. Not saying it doesn't work. I just don't do it that way. Like I said, there's lots of ways to approach things from a technical standpoint. Way too many. But that's kind of the summation of the way that I play the gaps. Okay, good. Nice little 13-minute video. Let me get that back out to you guys. It'll take a little bit to render, and we'll see what we have going on here.